All right, so we kind of talked about the language of finance over the past couple 3 days, and went through some example formulas for you to understand, what we talk about when we're talking about financing. And I hope one of the things that I demonstrated in showing that stuff to you is the importance of investing, and that's how we're going to conclude the semester. Is now talking about investing. All that market watch stuff I've been having you do now might make a little bit more sense. Now, the first thing you have to understand about investing, and I'm going to hit on this constantly as we go through, is that you do not invest for investment's sake, because then you don't know what to invest in. Is a 0.02% interest rate okay, or do you need something more along the lines of 12%? Is this something that you are just going to pull out of for retirement, or is this something that you're going to pull out of for college or for just the car next year? Uh, you have to have goals when you're investing so you can understand what to invest in, because different types of investments have different advantages and drawbacks. And that's really what we're going to go through now, is these types of investments, what the drawbacks and advantages are, and how they can better meet certain investment goals. Now, we're going to start at the most basic level of investing here, and that is what we call cash management and banking. And we're talking about more than just putting money in your checking account and getting it out. It's a little bit more involved than that when it gets to cash management, but certainly not much more complicated than that. And this is what I mean by the most base level. So the term cash management used to mean putting your money into a checking or savings account. And since each bank had similar interest rates prior to bank deregulation in the 1980s, there was little benefit gained from shopping around for slightly higher returns, because you weren't going to get that much out of it. However, times have changed. An increase in competition from non-banks. For example, State Farm Insurance had their own bank up until earlier this year. Uh, and a reduction in banking regulation have resulted in a much different environment today for managing cash and short-term liquid assets. The institutional environment has also changed. Previously, only banks could offer checking accounts, and only brokerage houses could sell financial assets such as stocks, bonds, and mutual funds. But now banks can offer financial services, including financial assets, and brokerage houses can offer checking accounts and other services. The challenge now is for you to understand the different alternatives available and to choose the alternatives that will help you achieve your financial goals the soonest. And this is why it's important to have goals. Cash management means how you manage cash and other liquid assets to meet your personal financial goals. Cash is important. It provides needed protection because of its liquidity. And this is the biggest advantage of cash. It's very liquid. Liquidity means that your funds are immediately accessible. Everybody will accept cash. I can't go to, if I put all my money into real estate, for example, I can't go to the store with a chunk of dirt and say, okay, here's a piece of my land. Cash, they will accept. Pretty liquid. Liquidity means that your funds are immediately accessible, and having liquid funds protects you from having to sell less liquid long-term investments at substantial discounts. Because if you want the money quickly, you're going to have to sell cheaply. So there are three main trade-offs regarding cash management. The first is the risk-return trade-off. Higher liquidity means lower returns because you can have your money in there a shorter time. And there's always the risk that you'll take it out before the person who is borrowing it from you, the investment, is through needing it. And so you have to accept lower returns in that regard. Generally speaking, the more liquid the financial asset, the lower the return you can expect to receive on the asset. The most liquid you could get, put that money in a drawer, but guess what your return is going to be if you shove the cash in a drawer? Nothing. Matter of fact, over the long term, because of inflation, you're actually going to lose money. So the second trade-off is the spending investment risk. Cash on hand is easier to spend than other financial assets. And you know that. I mean, how many times have you gotten a $100 bill and within the course of a week or two, it's gone and you're like, where the heck did I spend all this? Non-liquid financial assets generally require time and effort to convert to cash, and therefore you're less likely to just go out and spend, like I said, your investment in real estate as quickly. Cash is just easier to spend. The third trade-off is the return time expended risk. Since returns are smaller with existing cash management assets, the time you spend on managing those assets should be much less than the time you spend managing other types of financial assets. And that just goes to say, the higher the return, the higher the risk, and therefore the more time you're going to be sure that it is right thing to do. However, in spite of these three trade-offs, you can still impact your portfolio or the complete record of your investments in a significant and positive way by using your liquidity wisely. The key to using your liquidity wisely is relating cash management to your personal goals. What goals do you want to accomplish? Let cash management help you with some of them. For example, do you want to save more money? Automate your savings account and pay yourself first at specified intervals. You can even set up a portion, usually of your direct deposited paycheck, to go into your savings account automatically. Arrange for your bank or financial institution to transfer a specific amount of money each week or month into your savings or mutual fund account. Contribute to your company retirement plan each month with a specific amount that goes directly to that account. Do you want to cut down on the time you spend working on your personal finances? Use cash management software like Quicken or Mint.com is a good app. And when they are properly set up, these programs can substantially reduce the amount of time necessary to manage your finances. Now, there are many different alternatives for helping you manage your cash, and each alternative has its own benefits and costs, which is what I'm going to spend the rest of the day kind of talking about. Traditional cash management alternatives include checking accounts and savings accounts. And less traditional but important alternatives to cash management include money market deposit accounts, certificates of deposit, also known as CDs. So if you go in the bank, normally they'll have a big board there, the little white push-in letters that tells you the current CD rates. That's what those are, certificates of deposit. Money market mutual funds, or triple MFs. They're also known as, I know, funny term. U.S. Treasury bills, or T-bills. Series EE bonds and Series I bonds, collectively just known as savings bonds. The best way to evaluate cash management alternatives is to review the characteristics of each type of account. So what do you want to consider in what you're going to put your money in? Well, the first thing is liquidity. How quickly and easily can you access your money? For example, with the certificate of deposit. If I buy a certificate of deposit, a 6-month CD at, let's say, a 1% interest rate, if I take it out before that 6 months, I not only lose that 1% interest rate, but there may also be a penalty. So it is not extremely liquid. It's a lot more liquid than, say, buying real estate, which may take me a year or two to sell. This only takes 6 months, but it's not as liquid as cash on hand, for example. The minimum balance requirements. Some checking accounts or savings accounts to get a specific interest rate will make you have a certain minimum balance, or how much money must be in the account in order to qualify the account for the specific benefits, such as low interest rate or check writing privileges. What is the interest rate on the account, or the APR, annual percentage rate, or return received on the money in the account? The higher the interest rate, the more appealing it may be to you. But normally the higher the interest rate, the higher the risk and the less liquidity you have. The safety, or the guarantee that the assets will be protected by either a direct guarantee or an indirect guarantee. And what we mean by a direct guarantee usually is some kind of insurance, that if the bank's robbed or if they go under, your money will be protected. The insurance company will pay you it. And the insurance companies are normally run by the federal government. And you may have seen as you go in the bank door, there's usually a big silver sticker, looks like the door to a vault, and it says FDIC insured. Well, the FDIC is the Federal Deposit Insurance Corporation. And that's exactly what they do. If the bank goes under or if it's robbed, the FDIC steps in and pays that money. Hence why the FBI always gets involved in bank robberies, because the Federal Deposit Insurance Corporation has to pay for it, making it a national issue. The NCUA is the National Credit Union Association, and they do the same thing for credit unions. An indirect guarantee is something that, if the asset is a liability of the U.S. government, the U.S. government is really, 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 really unlikely to default on its debt. That would be a huge thing in the world if the U.S. ever said, I can't pay this debt. And that is true for any country. You also have to consider the costs of the investment. For example, my savings account has a $5 annual fee. Not a lot, but there is a cost to having the savings account. So this refers to the costs associated with holding the account, including late fees, overdraft protection fees, and minimum balance fees. And the best way to evaluate is, and the last characteristic of how to evaluate the cash management is the benefits. Some of these cash management options have special tax incentives. For example, savings bonds, if you're using them for education, are not taxable. So it could make your earnings tax-free and increase by about 15 to 30% how much you are actually able to get out of that investment at the state or federal level. So let's talk about each of these options in a little more detail in cash management. We'll start with the most basic one, checking accounts. They're the most common form of cash management alternatives. And checking accounts generally come in two forms. There are non-interest bearing accounts, which is what most checking accounts are. And there are interest-bearing accounts that are also called negotiable order of withdrawal accounts, or NOW accounts. So if you know someone who has a checking now, First Midwest NOW account, that would be a checking account that bears interest. Now, because checking accounts allow immediate access to your funds, they are among the most liquid of all cash management alternatives. As long as someone will accept the check, you have access to the money in the bank there. However, with that high liquidity comes very low interest rates because there's lots of risk that you might write a check over that the bank has to pay or something like that. So the rates on interest-bearing accounts, those NOW accounts, are usually very low and they're fixed. And I'm talking sub 1% low. We're talking maybe you get 0.01%. So not a lot of, if you're looking for a long-term, if you're planning for retirement, a checking account with an interest rate isn't going to cut it for you, basically, because it won't keep up with inflation. So minimum balances on checking accounts are generally low, but there's some variation depending on the type of account. Checking accounts from banks are very safe. They're insured by the FDIC, and they carry no penalties for early withdrawal. You close your account before the end of the month, no big deal. Banks, credit unions, and other financial institutions can give you more information on setting up a checking account. After that are savings accounts. And savings accounts, also called time deposits, are kind of the next on the cash management list. In the past, withdrawals and other transactions that affected a savings account would be registered in a passbook. In other words, you had this nice little leather-bound book. You'd go into the bank, and the teller would write down your balance and what the transaction was, whether you were taking money out or putting money in. Hence, the term passbook savings was coined. Savings accounts are now called statement accounts, and the customer receives a monthly statement from the financial institution. Money in a savings account is deposited for a specific term, for example, a day, week, month, quarter, and hence is less liquid than money in a checking account. However, with the reduction in liquidity, there's usually a slight increase in the interest rate for those accounts. Required minimum balances are pretty low, although it does depend on the type of account and usually what type of interest it's paying. Savings accounts are very safe. They're generally FDIC insured. However, there are penalties for early withdrawal. If you put money in your savings account, usually you have to wait 24 hours to access it at least, or else there's a penalty. Information on setting up savings accounts is available from banks, credit unions, other financial institutions. In addition to checking in savings accounts, the two most traditional forms of cash management, and there are other less traditional alternatives that you should evaluate and understand. Amongst these are money market accounts, or MMAs. It's an alternative to a savings account. An MMA very similar to a savings account, but instead of having a fixed rate of interest, its interest rate varies with the current level of market interest rates. So in other words, it's kind of like bidding on eBay. Sometimes the bids are going to be low, sometimes they're going to be high. So you're taking that risk by opening an MMA, but because you're taking a little bit more risk, normally the interest it pays off will be a little bit higher. MMAs are liquid. They do give you the ability to add and withdraw funds on a daily basis. So even though liquidity is high in MMAs, interest rates are variable though and are generally higher than rates on savings accounts because of that variability and risk. Required minimum balances may be much higher as well because of that risk, and those, and especially higher than those required for savings accounts. Maybe anything from $500 to $1,000 you always have to have in your account, depending on the account. MMAs are safe. They're generally FDIC insured. Other features of these accounts may include limited check writing ability. They may give you the ability to write 10 checks a month on the account or something like that, which means you can write checks though on your money market accounts. And there are generally no penalties for early withdrawals from an MMA as long as you do not go beyond the account's minimum balance. Information on money market accounts and how to purchase them can be found in the Wall Street Journal and at various financial institutions and brokerage houses. Certificates of deposits, or CDs, that I've already spoken about, pay a fixed rate of interest for your keeping funds in the account for a fixed period of time. And they're similar to savings accounts and time deposits. Interest rates are fixed for the life of the deposit, and the longer the term of the deposit, the higher the interest rate. CDs are less liquid than other cash management alternatives because money must be deposited for a certain amount of time. However, with that reduction in liquidity comes a higher interest rate. And the required minimum balance for a CD account is generally higher than it is for a savings or checking account. CDs are very safe. They're generally, again, FDIC insured. Money market mutual funds, or MMFs, are another alternative to bank savings accounts. They're not bank instruments. They are actually funds managed by mutual fund companies. And I haven't really spoken about what a mutual fund company is, but basically a mutual fund company, and I'll get into more detail later in the unit, is a company that buys shares of stock. You buy shares in it, it buys shares of lots of different stocks based on their expertise. So these companies pool funds from many investors to buy a portfolio of securities. And because they're working with pooled assets, mutual fund companies can usually purchase higher yielding investments that give higher returns to investors. So for example, you don't know what to invest in. You want to trust some experts. So you put your money in a mutual fund, and let's say there's 100 people like you putting their money into the mutual fund. The mutual fund buys a share of Apple. Well, you own basically 1/100th of a share of Apple. Now, that's what we mean by pooled assets. Investments can either be taxable securities. In other words, when you cash them in, you may have to pay taxes on them, or tax advantage securities. And what we mean by that are things that the government has said you do not have to pay taxes on these returns, such as municipal bonds, which are federal tax-free. And municipal bonds are where towns and cities issue instruments saying, loan us money, we will pay you back with interest. And they usually use that money to build certain things like the community pool, for example. MMFs are liquid. You can generally deposit and withdraw money every day. And while the increased liquidity results in lower interest rates, rates are still competitive. The rates depend on the funds. Minimum balances in MMFs are much higher than checking or savings accounts, though, and they may even exceed $3,000, $5,000 that you have to have minimum in there. While MMFs are generally considered safe, they are not FDIC or NCUA insured. Other features of this account may include limited check writing benefits. MMFs are bought by the share, and they do charge an administrative fee. There are no penalties for early withdrawal. You can find information on these from various brokers and from bankrate.com, which is a good little site that compares a lot of different banks' rates on what they'll charge you for these things, so you can kind of cost compare. MMFs may be either taxable or tax-free. We've already talked about, depending on the type of securities and the location of the securities the MMF invests in. If the MMF invests in only government securities, the interest earned is state tax-free, but not capital gains tax-free. Capital gains tax is the tax you pay on any money you make on an investment. It's different than income tax because this is not income. If the MMF invests only in municipal securities, like I said, the interest is federal tax-free. If the MMF invests only in from your municipal securities from your state, the interest may be both federal and state tax-free for states that have state taxes. Not every state has state income taxes. The next form of cash management on the scale is treasury bills, or T-bills. This is debt. The United States just decided that because of this big stimulus package they sent out for coronavirus, that they were going to borrow $3 trillion. Now, they don't go to banks and say, well, you loan us $3 trillion. They don't go to other countries. What they do is they process these debt, these T-bills, and they sell it. So they're going to sell $3 trillion worth of debt. Treasury bill is a form of debt. It's one of the forms. It's not the only way they'll get debt, but it's one of the forms. So T-bills are short-term notes of debt that are issued by the federal government with the promise that they will pay you back with interest if you buy one of these. In effect, you're loaning them money. So they can take from 1 to 12 months to mature, and investors do not receive explicit interest on these assets. T-bills are purchased at a discount. In other words, you buy them for $20, they promise to pay $25. That's how much it's actually worth. And when the bill matures, investors receive the full face value. T-bills can be very liquid depending on the maturity. If you buy a 10-year one, not going to be very liquid, but they're usually T-bills are pretty short term, 6 months or so they're fairly liquid. So even though they're liquid, interest rates are competitive with current market rates, though, because the government wants you to buy their debt. As the maturity of the T-bill increases, its interest rate generally increases as well. Required minimum balances are high, the minimum being $1,000. You can't buy a T-bill for less than that. T-bills are very safe assets, even though they're not guaranteed by the FDIC, but because they are government debt, it's a huge deal if the government would not pay it. So they're pretty careful about paying it. Normally, if a government doesn't pay its debt, it means the whole economy is going to collapse and they can't afford to even pay their debt. So, and no one's going to loan them money then to help rebuild their economy. So we would be in like a third world, poor, we're talking, some desert country and sub-Saharan country in Africa type poor if that were to ever happen. So other benefits to T-bills include their exemption from state and local income tax. And also, since T-bills are purchased at a discount and do not yield explicit interest payments, you don't pay taxes on interest until the bill matures. There are penalties for early withdrawal before maturity, though. Information on T-bills and how to purchase them is available from the Wall Street Journal. You can go to the government's website at treasurydirect.gov and various brokerage institutions. Other forms of debts include bonds, and that's really all a bond is an IOU. United States Series EE bonds are government savings bonds that are issued by the Treasury in small denominations as small as $25. And these bonds have variable interest rates. They're purchased at half the face value, and when the bonds mature, the full face value is paid. So for a $50 savings bond, you pay $25, and then when it matures, you get the $50. The interest rate paid on EE bonds is fixed for 6 months. In other words, Congress votes every 6 months or gives the Department of the Treasury the ability to set that interest rate every 6 months. And Series EE bonds are liquid in the sense that they can be cashed in anytime after 1 year. Ideally, you should hold on to them for at least 5 years to ensure that there'll be it will not be an interest penalty. After 5 years, those bonds can be cashed at any bank. Interest rates are competitive on them. Required minimum balances are low. You can purchase them, like I said, in denominations from $25 to $10,000. They are very secure because they have that implicit government guarantee again. Other features include interest being exempt from state and local income tax. Interest may even be tax-free if the interest and principal are spent on eligible college expenses, such as tuition and fees. One drawback to Series EE bonds is that there's a 3-month interest penalty if you withdraw funds before the specified term is over. Information on these rates and how to purchase them can be found at savingsbonds.gov. Investors can purchase savings bonds up to $5,000 per year in electronic bonds and $5,000 per year in paper bonds. In other words, you can go to the bank and buy the paper, but you can only buy $5,000 worth, and then you can get online and buy another $5,000 worth. And I never did understand what the difference, why, but that's the way they have it. If your modified adjusted gross income on your income tax return is above specified limits in the year bonds are cashed, then you won't be able to exclude the interest income from your income taxes for EE and I savings bonds. But usually that modified adjusted gross income is a pretty high limit. So unless you're making 6 figures a year, you probably aren't going to have to worry about it. I bonds are pretty much similar, except that they're not for educational purposes. They're usually to help stay up with inflation. Matter of fact, that's what the I in I bond stands for, inflation. They're government savings bonds that are issued by the Treasury in small denominations as small as $25. And Series I bonds have variable interest rates that are linked to the inflationary rate and a specified real rate of return linked to that. So Series I bonds, like Series EE bonds, are liquid in the sense that they can be cashed in at any time, but ideally you should hold on to them for at least 5 years to ensure that there won't be an interest penalty, and after that they are very liquid and can be cashed in any bank. The interest rates are variable, they change with the inflationary rate, and the required minimum balances are low. Bonds can be purchased in denominations ranging from $25 to $10,000, just like the EE bonds. Series I bonds, again, very secure because they're government debt. They have that implicit government guarantee of repayment. There's a 3-month interest penalty for each withdrawal if you cash these bonds before 5 years, much like the EE bond. Other features include interest being exempt from state and local income tax. The interest may even be tax-free if the interest and principal are spent on eligible college expenses, mainly tuition and fees. Because interest is not paid until maturity, there are no taxes on interest until the bond is redeemed. And information on rates for the Series I bonds can be found at savingsbonds.gov. And just an additional note on the Series I bond. If you're an older person and you don't want to risk your money, but you want it to stay up with inflation to maintain your purchasing power, that's what the Series I bond is intended to do. The interest rate is tied to the inflationary rate. So if inflation goes to 4%, your interest rate goes to 4% to keep the value of your money. Not a great investment as far as return, but a great secure investment as far as keeping up with inflation. Any questions about the cash management options that we talked about today? Okay, well, we'll move on to the next level then beyond cash management in the investment tree tomorrow to finish out the week then. So you guys have a great day and we'll see you tomorrow.